All right, good morning, everybody. Welcome to this session's July 20th of Planning and Scanning. In our notes section, you will notice that we have something that might be unique for some of you. Hopefully it works. It says error accessing file, not sure why, but I will repost it again in the Documents tab. We generally have uploaded in the past the document for the week, which is something I enjoyed doing a long time ago for myself, and then we shared it in the room. Many of you guys found some value in it. We put out trades for the week. We had earnings, all kinds of nice stuff there. So it was it just turned out to be a little much, but any event, due to popular demand, there were a couple things that we did there, which were seasonal trades. TTU 720, open it up, and it should be there now. For whatever reason, it didn't load before. Let's double check. Let's hope it works. Not much in the realm of seasonal trades to begin, but there's a lot of seasonal trades that unwind this year. And it looks like it's trying to work, and it should work. Anyway, in the document, what we did put together was, let's see, where did it go? I just saw it pop up. This is acting really squirrely. Must be, here we go. Anyway, what I see in the Documents tab, I think everyone else should be able to upload it. It's in Word in the Notes section, and here it is. So everyone should see that. We still have a cycle analysis that's calling for a peak in prices in the third week of July. That's this week. Prices accelerated on Friday right into the close, and a couple interesting comments here or observations. The S&P 500 and the NASDAQ 100 traded well above monthly R1 pivot resistance, which were, at the time, 2103 in ES, 4507 in NASDAQ. The Dow is trading right near its respective resistance, which is 17,935. The Russell is well below its resistance, and the NYSE is well below its resistance, and I'll show you that as well in just a few minutes. I believe that the market right now is still vulnerable for a potential bearish divergence in both S&P 500 and NASDAQ 100, unless by, let's call it, typically it's 1 to 2 days, sometimes 3 to 4 days. So let's call it by the end of the week, unless that the breadth of the market and the volume improves quickly, then we could be sitting up for a significantly failed rally, a higher degree failed rally, believe it or not, from a bearish divergence perspective in the breadth and volume analysis. The McClellan oscillator suggests that we're slightly overbought with a high reading last near 156. Now, this is another really bizarre tale, because as stocks rallied last week, the McClellan oscillator went down, and it finished from 156 on an intra-week basis to 90. And the weekly remains below the zero line reading at negative 78. So the leadership in the market is biotech. So far year to date, it's up 31%. Second place is XLV, up 13%. The laggards, transportation, the IYT is negative almost 9%. Utilities down 6%. Semis are off by almost 3%. Industrials down 2%. Materials are down 1%. So again, with oil prices down, the worst performing sectors year to date are OIH and XOP, both down close to, well, 12%. So that's what's been going on in our market. We're hitting full force of earnings season this week, and I ask what could cause the markets to stall or cease moving higher. And we've had everything in the kitchen sink thrown at this market, which did cause some unrest and concerns. One was, of course, China, then Greece. In my opinion, I think it was more of a China story than it was a Greece story, truthfully. We saw what really didn't become very publicized here in the United States, but what was publicized is abroad when I was in Italy last month, was that there were reports that Chinese investors who had large hoards of cash warehouse receipt holdings of copper and even gold and precious metals, silver too, zinc, aluminum, they were using those cash warehouse holdings as collateral against their losses in the equity markets. So if I'm the brokerage firm and someone shows up with a receipt saying, here's my, instead of cash, here's a warehouse full of copper, or my receipts for my cash holdings, as a brokerage firm, I may sell and hedge in case the prices go down and then we lose money. So we don't want to be using and sell the product. We just want to hedge for protection against further erosion. And that put pressure, I think, on the gold market. And today we walk in the board and we see gold break that magic $1,100. The 1136 and then 1113 area is for gold a strong, and was a strong support. Gold, we need a daily close above 1146. Now that's out of the way right now. That we're going to change that up, because that would be an LCC, a last conditional change breakout. Monthly support is 1136. A weekly close above 1163 is an LCC breakout on a weekly basis, and quarterly support was 1118. So we've got to change this based on last night, overnight's sessions, because we're going to have a new last conditional change, and I'll get to that in just a minute. Bonds formed a weekly, Treasury bonds formed a weekly high close doji. Resistance is up near 155. Soybeans, seasonally weak, but still in a weekly buy mode. Watch for a weekly low close doji. These are some of the commodities that we need to kind of go over. Crude oil enters a seasonally weak period. Next major support, 45, with 57 double nickel as resistance. Corn formed a daily low close doji near monthly resistance, so we want to kind of watch that. As far as seasonal commodity spreads, nothing really new in the month of July to put on, but you have a bear spread that's been on since the latter part of June, buying May corn of next year and selling D's corn. That's a bear spread. So you're selling May corn, which should be May, and I probably want to insert, since that's 2016 May versus 2015 December. So that's kind of a bear spread on new crop. Remember, what's harvested in December is new crop, and May would have been new crop. So it's a new crop spread. If the corn, and if you get into good crop growing conditions, you want to be in that spread. And you can be in that until September 25th, okay? Buy D's wheat, sell D's corn, same thing, on or about 625, and you hold, and you get out of that this week. So there was really no new trades in the month of July on seasonal commodity spreads. Reports this week, very light today. So we get a light economic report. Bank of Japan minutes come out tonight. Red Book tomorrow. American Petroleum, we really don't have a lot in the form of economic numbers. Globally, the Bank of England minutes come out. Existing home sales, you guys can read through this. I think one of the big things is going to be, of course, the new home sales that's coming out on really Friday, leading economic indicators and existing home sales. So if you're thinking that it's the housing construction business that's driving the U.S. economy, then we want to focus in on those reports, which come out Wednesday, Thursday, and Friday. Okay. Next, earnings. Name it. We've got some banks today. I didn't list the exact times. I think you guys can do that, and you'll probably figure this out. What I'm going to do is go through some of these high flyers, and this week try to look for some convergence and opportunities for some earnings setups. So despite Google, which really over-accelerated itself, Netflix, Amazon, these are the big behemoths that have really driven the market in the last week. It's just a few big cap names, and that's one of the things that I think has driven this market. So that's probably why the breadth remains on the weak side. So anyway, that can be available to you guys, and as we discover a couple little things here, when we look at the market, the rally over the last few days, and I mean, it was literally 1, 2, 3, 4, 5 days. And then Friday was just one of the most bizarre little trading events that we've seen. It was just, I know a lot of traders just cut out. The volume has been on the OBV, cumulative in nature, very strong. A little in recent history, you know, when we gap in the OBV by the moving average, another little unique technique that I like to look at. I'm not sure what, you know, how many more days this thing can go up, but I'm expecting an eventual correction in the market because this OBV, as we start to see divergence in new highs in price, I just am very suspect of this reading in the advanced decline. Let's take a look at the NASDAQ and the Qs to share with you what I'm really expressing. If the market is super strong, and that was just a, gosh, that was a rocket ship, one of those ST model rockets we used to play with as a kid. You fire that bad boy up with a D rocket and get some of that waterproof, which I don't think they sell that stuff anymore. Remember the green fuses we could light, you know? Any event, when we take a look at this, I mean, clearly we can see something's wrong with this picture, not to be trusted. So a cycle high coming due, number one, divergences in the advanced decline analysis. Yes, the volume picked up on a day-to-day basis, but look, we still are forming a divergence with the volume analysis versus the price analysis. So something really, really wacky going on. Let's take a look. Here's the Russell as identified by the IWM. Definitely we see a deterioration, deterioration in the advanced decline. Look where, and again, what I was describing, the monthly pivot resistance, way up there in the Russell. The Russell was once the strongest of the leadership of the market. We identified and got into IWM puts several weeks back. Remember that? And then the market went down. Now it's, ironically, it's the weakest of the components based on the relationship of price to its respected pivot analysis. So the Russell with the similar situation, notice that there's a consistent pattern of lower readings in the AD lines. And the volume here is not nearly what it looked like as far as what? Both the S&P and the NASDAQ. So this is suggesting that perhaps we could see follow-through weakness in the Russell. And if the market does give it up a bit, it's going to come probably more downside first in the Russell as a relative strength analysis than the other two markets, the ES and the Qs. On the NYSE, if you just drew a simple trend line, most people would say, gee, the market over-accelerated, popped back, over-accelerated downside, and is trying to pop back, and it's not even getting to its downtrend resistance. Meanwhile, we are certainly seeing a consistent theme that we've got lower highs projected in the advanced decline in the NYSE. Note that we are just at a monthly pivot resistance for the NYSE, which person's pivots, the indicator has determined that it is a bearish month. So this is up near resistance as we close in the last week and a half of trading here. Well, actually, we really have almost, what, 2 weeks left of the month. So if I'm not mistaken, I think it's about 2 weeks left of the month. Almost 2 full weeks, because this month is a long month of July. So here's the Dow Jones Industrial Average. We're getting stochastics readings a little lofty. The volume analysis doesn't reflect really strong ability to see a breakthrough. And even though this is only 30 stocks, we are seeing that divergence. And this is what I was defining on a day-to-day basis. Now, this is the end of the week, and we like to look at weekly stuff. And the weekly analysis looks very similar in nature. Kind of spooky. Markets don't make 4 or 5 days pops. We are more or less at the top of a range. Yes, we can go higher. We've seen that where markets can take out highs, temporary, and then they can form you know, a tricky topping process or a topping pattern. Last fall, we noted towards the end of the summer a broadening top pattern. I'm not saying this is one here because we didn't make new lows, but we can see a new higher high, and the higher it goes without contribution of the breadth and volume combined, the more susceptible it is to price decline. So I'm not sure where the weakness or what catastrophic event's going to require. That's why I wrote, I'm not sure what the I wouldn't call it a black swan event, but we do have the Federal Reserve meeting next week. It's light economic reports. It's heavy earnings coming out this week. And those are the I think from a market to focus in on, it would be not the strength of the S&Ps and the strength in the NASDAQ 100. I think the real focus would be on the relative weakness in the Russell to see if that does get stronger, then it would help support the argument that this stock market's never going to go down. Or if the Russell continues to get weaker in price and in structure, then it tells me that potentially the market is going to get a turnaround as we head forward. Now, looking at the commitment of traders reports, we note a couple little really neat things here. The commercials have been sidelined. Look at this red line here. They're just barely flatlined. I just have to go back in time and say, when was the last time we saw literally almost 1, 2, 3, 4, almost 5 weeks of flatlined neutral in the last forever? I mean, I just don't show a flat line at the zero line. I mean, it goes a little above, it goes below, it joggles back and forth, they adjust positions. But folks, look at that. It looks like the market just died. No hedging going on by commercials. That's the red line. COT commercials, red line. Flatlined at the zero neutral line. This goes back, I mean, it takes a while to see that type of analysis. Something that is, if you're perplexed, I mean, I'm looking at indicators that very hard to see. Here's a 3-week flat line, but not literally a 5-week flat line. And that was, by the way, in 2003. I had to go back 2003 to see some of this stuff where there's no interest. And in here, in June of 2001, kind of like no interest in the market in here at all. So the market's not demonstrating by any stretch of the imagination a lot of confidence from commercials wanting to hedge. And the only one, we've got the hedge funds on the short side of the market, commercials darn near neutral, and then we've got the general public running the roost. Generally not a real high confidence builder to say, boy, this market's really susceptible for the long side. It's not to say the market can't go up further. Market could go up for forever, but when it does come down, will you be able to get out if you're long, or be able to put on positions to get short? That's the key element. So, we've seen a lot of different markets that have had some really, really strange behavior. Gold closes on the lows. We were talking about last week in this trading room. We saw the commercials reduce their short side exposure. It starts to get neutral here. And the irony is, when we start to get neutral and they start to converge, meaning hedge funds and commercials converge, it's closer to short-term bottoms in the market. Now, what I'm looking at is noting that in gold, we have had a more of a significant, with today's price action, and this is, again, the week's not over, but as I can share, there's where the current price is in gold. Here's the last real low reading, and then we'll kind of get a gauge, because we are forming more of a convergence, bullish convergence. The lower the price goes, unlike liquidation volume, tells me that the market just maybe had flushed whoever the long holders in the COT data was. This is a seasonally strong period of time, but we haven't had a trigger to go long. We've been looking and talking about if the market gets back through the daily opening range, and the close would set up for an oops. And I'm probably going to suggest that today at around that, and I understand that's a $20 move from here, 11-12, but I'm not catching the falling knife in here. I want to look for market synergy of bullish behavior. And the first sign of bullish behavior for gold would be at least show me a close above the open, right? That would be a green candle. That's for one. Let's start there. Next, let me see at least some type of a bullish setup, and we just haven't gotten one over the last few days or the last week, which may have led to this accelerated sell-off, which could have been a capitulation. So now we're forming almost a potential bottom hammer formation that I think comes at the end of major declines. And with the longer-term weekly volume analysis suggesting a potential bottom, I think that we need to respect this could be just that. It could have been just a margin call liquidation, someone heavy with a wrong position. And when we take a look at the overseas markets, it's really not coming from China, because the FXI overnight down 0.5%, not accelerating to the upside, but I think gold someone just got may have possibly been puked out of their position. I don't think this, to me, is a concern for a immediate longer-term decline to zero or $800, but I think that we are near with the setup of the longer-term volume patterns, number one, the strong seasonality, and this scenario here where we've got the hedge funds converging and the commercials converging. To me, I think it bodes well that we are probably putting in a bottom in the market in gold. So the other market that we had on target was last week. We put on some TLT calls because we were looking for the market to pop in the bonds. We saw a strong convergence in volume, and we did form a weekly high close doji officially in the bond futures. We haven't seen any follow through on strength with that volume, but that's why I said I think that we have an overall month-to-month resistance targets very strong up near 2 weeks ago's high, which is that high right there, which was at monthly pivot resistance. Note that we are now towards the end of the month, or closer towards the end of the month than we are the beginning of the month, and the market's tried to break and it hasn't on a month-to-month basis, and we are now trading back above pivot, which is the monthly blue line. So from a technical perspective, we are starting to maintain prices above a support level for longer term duration. If they can't take it down, they're going to want to try to take it up. So I'm thinking from a seasonal perspective, the fact that the commercials are getting long, the hedge funds are neutral, and the public here, once again, the small specs are on the short side of the market. They might be right for a little bit, but the last time we again saw that the hedge funds and the commercials were on the long side and the green was on the short side was when the market was basing out and bottoming out. So that's kind of, as you can see in here, the public tends to get really long at highs and they tend to get really short at lows. So every blind squirrel finds an acorn, but not in this many markets. So the fact that they're long the S&Ps, they're short the bonds, the general public is on the right side of every single market right now is a little scary to me. So once in a while they're right, but on every single market from a trending perspective, we got to be aware of that there could be some immediate changes pretty soon. So anyway, that's our weekly wrap up, and everyone, I hope you at least will be able to utilize the trading plan. The trading plan, and that's the opening bell here. The trading plan that, as outlined, I am still significantly looking for a, believe it or not, correction. And like I say, watch the Russell, focus in on the Russell this week, okay? So that's what I wanted to have mentioned to you, all right? That does conclude today's session. Everyone, have a great trading week. We'll see you in the trading room.